Hey guys, welcome to Real Job Optional Freedom. Real estate can be complicated. Let an investor guide you. We are here to demystify the complex nature of real estate by getting you answers from professionals who are in the trenches so you can be the hero of your real freedom story. Welcome to Real Money, a weekly segment of the Real Freedom Podcast where we ask the most pressing real estate questions. I'm here with my co host, Kevin Gilbert, and I'm Chris Bell. Today, we are going to talk about wages and how that impacts the rental market. And we're also going to talk about single family, multifamily, syndications, and REITs. And we hope you guys learned something from this one. So, first up, Kevin, we talked about wages. And kind of this question that comes to mind is we're seeing minimum wages going up, we're seeing other wages going up. We've seen it from vendors, we've seen it from employees, we're seeing it kind of all across the board. And my question was, well, do wages ever go down?
Uh, I haven't looked at a chart for that. I think occasionally you see small percentage decreases. Traditionally, uh, part of that equation is inflation, right? The value of your dollar is changing, so the wages tend to change, right? But sometimes you hit a market boom. And if you look historically, there's a couple spots like the 1940s was a big one, right? We had a lot going on, world wars, that kind of thing. So there was a huge demand for stuff. People's wages were going up. There was a big boom across the board. And you can literally see on charts as the percentage of wage increase, from 6 to 7%, you can see a lag of about a year where the housing prices go up, right? So Joe Blow and his family get a raise of 5%, and suddenly they realize they can afford a slightly larger house. Their payment might be slightly larger. Next thing you know, all the houses have gone up in value just a little bit, right? And you can see that throughout history. So, wage changes are a big driver for, monthly rent, price of the retail price of the house, all that. Uh, you do see it occasionally drop, but I don't think it's nearly as large as a percentage. Like you'll see, in good times they go up 6%, and in down times they might drop 0.5%. So I think
Yeah.
they've gone down, but I'd have to look at that data. I haven't pulled it up of late.
Yeah, it's just interesting to me, just thinking that if the thing that drives both the rental market and maybe the housing market on the is what people make or the income that they make. Also, the interest rate. So basically, your 30-year fixed interest rate. That's definitely a driver, and that comes into the equation. So if people are making more and and wages never come down, that would be a good sign to basically say that, basically rents are likely to go up because wages are going up, and they're likely not to come down. So, just the thought of, people don't want to get caught in this bubble, if you will, of, oh man, rents went up 20, 30%, and they're going to crash down. And, you look at that and you go, well, as long as wages don't crash or go down in any kind of significant um, form over history, then we're probably in a pretty safe spot with these rents that are going up around the country.
Well, one factor into that is a statistic I saw maybe 2 weeks ago. So we're going to call this recent. Is there's about 1.7 jobs available per person, right? So you factor in, we're seeing inflation, we're seeing wages rises, but also we're seeing a huge job availability, right? Like as those wages increase, you are gonna, it's all supply demand kind of stuff, right? As the wages increase, as the cost increases, you're gonna see the demand for employees drop. It all balances out in the long run, right? So we might see it go from 1.7 jobs available per person down to, what you are actually looking for, which is, one job per person, right? Like kind of a ideal dream version of full employment. Um, so you're going to see that adjust over time, but man, the indicators, I made predictions in 2006, 2007 when I was much younger, and when the market crashed, I was like standing there a little surprised, right? So I hate to make predictions, but I mean, we have some strong data to say that those rents aren't going down. So
Yeah, I think the one thing that is, kind of outside of our control, and I think everybody's got to be mindful of this, is rent control. So you've seen, markets like New York City and other markets on the West Coast that have implemented rent control, some of them statewide. And, that's a tough deal for a landlord because they get into a situation where over time, maybe initially it's not that bad, but over time, as inflation kind of creeps in, it starts to get to a point where, tenant number one from 15 years ago is paying, I don't know, let's call it $1,000 to live in a property. And then all of a sudden, for the plumber to fix the toilet, it's $1,000 to fix the toilet. And the landlord's going, well, I can't even pay to fix the property. It ends up in a pretty messy situation.
yeah, that's there's a couple situations there, right? There's a couple characteristics that are going on. Usually there's a shortage of housing supply. So there's an interesting factor I saw some data on, and it said it's the not in my backyard problem, right? You got a city and they love their city and they don't want multifamily or low income housing or fill in the blank, right? And then so they don't build it. So then you see this lag of, X number of years later, you have a severe shortage of available properties, right? So what happens? Now you got a lot of people fighting for a limited number of properties, and the rent goes up because there's a huge demand and short supply. Then you have people freak out. You're like, how's a normal family supposed to live here, right? You're seeing that in California right now, around San Francisco especially. So it creates a large number of homeless people. It creates a real challenge for working families. And you can look back 10 years and be like, well, you guys, uh, X corporation wanted to build a 400 unit apartment complex and you told them no. And years later, the city needs X number of units for families to live in, and they don't have them, right? So then, uh, government policy, you're looking for various fixes, and people are just looking at a fraction of the problem instead of the whole picture. And I think that's why, um, you know, that fixed rent stuff comes into play, is because it's very attractive to just be like, well, we're just going to lower the rents. These greedy landlords, blah blah blah, fill in the blank, rather than, you know, um, we as a society and a community in this area have a bigger problem that we've not addressed for a very long period of time. So, then you look at it once the fixed rents are in place, um, and you start to see over time inflation goes up and the rents are, you have this fixed wage, and yet your expenses are challenged, right? Anybody who's run a budget knows that there's two problems. You either got a spending problem or an income problem. So you and your family need to get to work, right? Well, if you're running a property and the income is fixed and the expenses are growing, you got a long-term problem that's not solvable, and you really need to exit out, right? And I think years ago that was a real problem for people. But after 2008, you started to see a lot of people just be like, I'm just going to let it go to the bank. This is no longer viable. Foreclosure is now a real option in people's brains. So, people want to push the problem off to somebody else, in this case, the landlord. And I think, you know, I think this is a tough problem, because you're talking. It's a big problem for all of society, and you know, government's not good about nipping it in the bud. They're much better at pushing it down the road for the next politician to deal with. So
Yeah, I like what you said about the not in my backyard. I know that you know they say in a lot of the bluer leaning voting states that everybody wants low income housing. They want to house people, but when it comes right down to the brass tacks of it, those people that are on those city councils, they're voting no if it's going to be anywhere around their house or where they live. And it's just interesting to see that where people are on one side saying, yeah, we want it, we want it, we want it. And then when it comes right down to it, they're like, yeah, we want it, but not in my backyard. We want it over
Yeah,
there. So,
it's funny. It's like it's like dealing with kids, right? You got a 6-year old. There's nothing is understood other than instant gratification. This always almost feels like the government version of the same problem. Is like we as a city, a state, a nation, we have a problem, and instead of like doing the hard thing up front and come up with a viable solution, we kind of kick it down the road. So yeah, that rent control, it's kind of like
so one of the things that I think is interesting too, that I think a lot of really pay attention to is the financial health of a city, right? So we know our nation is trillions and trillions and trillions of dollars in debt, and at some point they've got to get that money from somewhere, you would think. So, one of the things they can do is raise taxes, or what they're doing is they're trying to inflate the debt away right now. But the other thing that's interesting, there's some websites out there that will basically they do a financial audit of, like, I think it's the top 200 cities in North America, and they basically tell you, based on those cities' balance sheets. They're a few years old, but they'll tell you, hey, this city is running a deficit of, you know, $100,000 per person in the city. So they grade them, A, B, C, D, E, and you look at that and you go, well, if a city, if their main source of revenue from a city level is taxes, probably their biggest level of taxes is real estate tax. So if you've got a city that is basically not being run very well, the likelihood of them looking to raise taxes is probably going to be at the real estate level. And there's really nothing you can do about that. That, as a landlord, that it squeezes your margin, and the only thing you can do then is raise rents if the market will allow it.
So yeah, that's one of the things that small individual investors typically overlook, right? They basically want to invest in a property that they can drive to and it's nearby. Once you start getting into the bigger, I don't know, nationwide investing, and you're starting to look at properties outside your immediate drive radius, there's two equations people really look at, and that is one of them, right? Is the city well run, right? Is the government uh, pro landlord? Is the government competently managing the taxes that they're receiving, right? Like, is it a well run area? Is it a well run state and city? That's one of the things you look at. The other one you look at is it a growing population or a declining population? There's a couple cities I've been interested in a long period of time, and I can't go there because I know that over the past 30 years their population has been declining, and that's a long track record. And there's nothing there to say it's going to change in the next decade, right? So, you know, we go back to supply and demand. If there's a X number of houses and nobody's building new houses, but your population is declining, well, then demand for your house is not going to increase, right? So, there's definitely parts of the country that are growing, that are thriving, and there's parts that are, people are moving from. One of the things I've started to love, and I'm starting to see it in the data come up here recently on some of the YouTubers and podcasts I would listen to, is the wonderful migration chart you can find on the U-Haul website, right? And I'm a big fan of it, but you can literally, like, where do birds move, right? You can watch the migration of the birds. Well, this is migration of people, right? And a great way to track it is where are U-Haul trucks in demand and where are they being left, right? Where are people leaving and where are they going to? So one of the big obvious ones is that they're leaving California and going to Texas for a number of reasons. But I love looking at that migration chart. And if you're planning to buy real estate outside your area, that's one of the first places you should probably look.
Yeah, you definitely want to have a growing population, and you mentioned it. I know there's a city up north from us, and the rental real estate, it's just like what you can buy for is amazing. It's like, man, I'd like to go there and buy up entire blocks. But at the same token, you look at that and you go, well, they had a population that used to be millions and millions of people, and now it's half of what it used to be because they've had a population decline over the last several decades. And you go, well, at one point this area had housing for all of those people. Now they've got half of the people. So when you look at supply and demand on your rental, like, sure, you can buy a super cheap rental, but who's going to live in it? Like, how
Mm.
low do you have to get your rent to basically get somebody to want to live there? So
That's another problem people run into when they're shopping outside their areas. I don't know, the opposite of sticker shock sometimes, right? So you got an investor in California or investor in New York who, realizes that buying a rental property in the area may not be ideal, and they start looking at other markets, and they're like, you know, they're used to paying $500,000 for a property, and they're like, "You mean I could pay 50? What a deal!" And if you actually do the research in the area, you might be like, "Well, 50 probably is just a regular price. It's not a deal." So,
yeah, absolutely. I think it's too, when you start looking at properties outside of your area, just understanding that some of these ones that are super cheap, or at least look super cheap, um, it's that way because of a reason. They could be in literally the war zones, um, you know, drug infested type thing, and where the poverty rate is extremely low in a given zip code or a given area, which is definitely going to increase your, like, sure, you can get somebody in it, they can pay for 3, 4, 5, 6 months, then they lose their job, then you're going into a tenant turn, and like, so just the cost to kind of have those properties is significantly higher than you would think. And I think just understanding what you're getting into if you're investing in those areas is really important, because a little bit more money to be, on the quote unquote on the other side of the railroad tracks, you could get a much steadier rate of return, because you're a little bit above the poverty line, and people can afford to live in the properties. They're holding jobs. They're not job hopping, every couple of years, and it's a more stable investment.
yeah, I mean, we're getting off topic, I guess, but I also don't want to scare people away from that stuff. I've had properties in all of those categories that have thrived and given me a significant return. But it also depends on your comfort level, right? If you're new at this, you're probably going to want to go, you want to shoot for the medium income area, right? If your medium house in the area is I'm making up numbers, but let's say it's $300,000, you might want to stick it at a $300,000 house. It's going to be in a better area. It's going to have, it's going to have more likely to have a tenant who stays long term, but it's also going to have more, certain costs. And then the lower, your return might be better on a property that's half of the median income, but your workload might be better. It might scare you off. It might not be for you if you're brand new to this stuff. So the interesting about this stuff is there's a comfort zone for everybody, right? I've seen people who thrive in the war zone, but they're very hands on. They're knocking on doors, they're into there turning their own wrench. I've seen people who do fantastic with the high end properties, and they prefer the calm stability of, the likelihood of having to go for collections is reduced, or, um, they value the appreciation, whereas the guy on the low end might be solely focused on cash flow. So
Yeah.
I don't want to scare people away from those properties, but it's definitely stuff to research yourself and find your own comfort zone. But
Yeah.
I do believe in each one of those categories that over the next couple of years, we're probably going to see the rents go up. So,
Yeah, I just talking about like the low end and being hands on. I remember meeting a landlord who literally drove his tenants to eviction court. So if he was kicking them out because they didn't pay rent or what
get in the
have you,
car.
he he would literally give them a ride to court to evict them. And I just remember thinking, wow, like that's a whole nother level. So
Yeah, that's not where you want to be. That's not the ideal version of investing, right?
that's right. That's way more active than passive. And so let's go into this. Let's talk a little single family, multifamily. Let's talk a little bit about syndications and REITs, and just kind of our thoughts on those. You know, first off, I'll just start. Single family is where all of my personal investments are at. I like single family because it creates stability there. Just not wanting to go and so I learned, basically how to take, $50,000 and make that make money, right? So I've got a comfort level in the single family homes. I pay attention to single family homes on a daily basis. So I know in the markets that I invest in immediately if something's a deal. I understand, what a water heater costs. Like I understand all the cost involved. So I personally like single family investing. Um, so what's your take on single family, Kevin?
Well, I mean, much like you just said, I have a clear bias, right? But that's also active stuff for me, right? So, like you said, you're paying attention daily, so you're aware of what the prices are daily, which means when a deal shows up, you don't even need to do research. You know right off the top of your head. So I'm a big fan of single family, but I don't want to rule out the other options, especially if you're looking to have money work for you. Um, I love the idea of REITs, but historically, I've found their fees to be too high for me. It kind of steals a lot of the value there. But man, I haven't looked into it, but I bet you in the last year or two, if you were in a REIT, you're really excited about it. But I haven't looked into it. But traditionally, they kill you on the fees, right? So, um, the property should make a great return. The property probably does make a great return, but after all the fees and you hit the bottom line. Um, you're probably under 10% return. I think I remember seeing a number about 8% as a long term statistical average, but I don't want to swear to that. Um, Basically, I feel you can do better in the single family controlling your own destiny. And while I love the concept of REITs, I do feel that they fall into the same category as a stock. I can't walk in there and do anything to change any of the numbers, right? I can't, you know, paint it and make it prettier and add value. I can't, have a conversation with the tenant and raise the rent. Like I'm a spectator because it's a big deal, and my money is just one small percentage of the the that particular REIT. So, you lose the control, and with that, you lose the potential for return on your investment. So, I love the idea of it. I think I'd love to just do that project as just my own personal deal, and not as part of a REIT, right? But I love the idea of large multifamily. The financing that those guys have been getting from the banks for the last couple of years just you know make things work really well. Rates are going up, so I'm curious to see how that looks in years to come. But I mean, you know, the data is still showing that across the nation we've got a 4 million household shortage. So I don't know that there's a way to solve that in the medium term other than some serious massive multifamily projects, right? So I do love the idea of the REITs. I just think, I think there's too many. They nickel and dime you is what it feels like. So.
Yeah, I would say that you mentioned it. You lack some control when you're dealing with a REIT, and I think what we all have to remember is if you're whether it's a REIT or whether it's a syndication, and sometimes depending on your involvement, multifamily or single family, you're hiring a property manager and also potentially an asset manager. So it, whether it's a REIT, multifamily, or the single family or the syndication,
Also,
somebody's hiring a
I
manager.
feel like
Those
we're
fees are there.
yeah. That's also, you can Google a REIT, but it's industry lingo, right? It's a real estate investment trust. It's a company set up to do a large project. Sometimes they do a number of projects, but sometimes it's just one project. But real estate investment trust is, what that stands for. So
Yeah, clarifying that, Kevin. Sometimes we're just spitting this stuff out. And just to go a little bit further, syndication is similar to a REIT, where it's a general partner typically. Somebody raises their hand and says, "I've got a deal. I found a really good deal, but I don't have the million, 2 million, $10 million to put into this deal to execute on the vision and on the numbers that I see." So they will raise private capital, and typically that's through a syndication. So you're basically giving your money to somebody. Typically there's some type of preferred return, and then they call it like a waterfall return after the fact. It could be that they're planning on owning the property long term forever, and they're going to refinance it and give your money back. But again, you lack some of the controls. You're really investing in the people, in the vision that you're giving the money to. I've seen some of them that say, basically, once you give me your money, you have zero control. We're going to use your money as wisely as we can over whatever period of time we can. So,
these can also go to zero. Like when you buy a single family property, you might get foreclosed on if you have debt. If you don't pay the property taxes, the city will take the property. A REIT and these projects, they're on 5-year money, right? The loans are typically amortized over 30 years or just interest only, but they have 5-year balloons, 5 years, and you're supposed to either sell the property or refinance and something. And a lot of these guys got caught in 2007, 2008 when the market fell apart, because they had those dates coming up, and there was no new lenders, right? All the lenders had gone out of business, right? So that's something else you got to watch out with that kind of stuff. Is most of the time your return is going to be there and it's going to get paid, but those loans do have a 5-year call date, right? So
let's talk a little bit about multifamily. So multifamily, um, to me, is a duplex, triplex, a fourplex. Um, and I think you could get a residential loan for a fourplex and under. I think once it's above, it ends up.
I've
So
actually
a
run
lot of
into a
people.
number of properties where they took a 5-bedroom, 5 unit, and they took one and made it a really big unit so that it was a 4 unit for that very reason. I remember walking through the first time and I was completely perplexed on why is this one unit ridiculous? And it's because it had been created as a 5 unit, but the loans are, you can get the residential loans for up to four. After that, you're literally on a different program with the bank. So
Yeah, so if we've seen some of this house hacking, military guys in our area. They'll buy a fourplex at retail price, and they'll live in one unit. So they'll be owner occupied. They'll rent the other 3 units out. Will pay their mortgage, pay all their expenses, and probably pay for the room that they're staying in. Um, and so, like, I don't have anything really against like the small multifamily, but what I've seen from basically managing hundreds and hundreds of these types of properties um, over a decade is that what everybody tells you, and that's you're buying multiple units because you'll never have 100% vacancy, or it's going to be full. You'll only have a small percentage of vacancy. That is true, but what they fail to mention, and what I've seen over and over again, is that very rarely do fourplex units stay 100% occupied for an extended period of time. There is almost always one, if not two, of those units turning over on a very consistent basis. And what ends up happening there is if your property manager or yourself is not 100% on the ball on tenant turn cost, making sure that you've got low vacancies and they're trying to remarket it and they don't have some type of favorable fees on lease up. Um, that turnover can cost of your return. And while it looks good on paper, you have to understand that most multifamily, these, threeplexes, fourplexes, um, are built as low cost as they can be built. So when the upstairs unit, when the tenant is walking around, the downstairs unit thinks they're doing jazzercise. Like so there's just a lot that comes into play there that's basically making people move. Or the downstairs unit, the person is, doing illegal drugs or something like that, or they're up until 3 o'clock in the morning because, they work a day shift or something like that. So it's basically causing these micro friction between tenants, and they end up moving, which ends up hurting you as a return on your investment in some of these. Kevin, what have you seen? You've owned several of these fourplexes, duplexes, and stuff like that. Tell us.
So I actually remember, and I avoid this particular style of property now because of it. But I remember a little old lady who'd been in the property for a very long time. I was standing in her living room, and she was complaining about the people upstairs because they had three kids. And she's like, "These kids bouncing around, jumping around all the time. It's driving me nuts." And she's like, "See, right now." And you could hear a significant amount of noise. And it did sound like, they had their clogs on and were doing, all kinds of chasing each other around, right? So I said, well, let me go check out what's going on. I walk up there, knock on the door, and it's immediately opened. And there's three kids sitting in like plastic chairs around a kid's table eating their sandwiches, and they're just like calmly sitting there like that. And I'm literally staring at the furniture, and I'm like, that is what's making that insane amount of noise downstairs. And the kids were as calm as could be, but just every little movement sounded like elephants charging through the room from downstairs. So since that property, I have avoided multifamily that were not, next door to each other, kind of like a townhouse or a row house kind of structure. The up and down is, whew, buddy. Like, you're right. You could construct the properties to have soundproofing, but those lower end properties, they never put it in. Oftentimes, there's not even any kind of insulation between those two floors. It's literally just, there's a rock, a couple, boards, and then your ceiling, right? So there's an echo chamber there. So one of the things about that is, I was told a year ago from somebody who manages a 400 unit apartment complex that's pretty freaking nice, like medium rental market for the area. I think their average rent was like $1,200, and the area's average was $1,200. So these are not low end properties. He was telling me his turnover rate for that was 60%. So you got to imagine, like, what does that mean, right? What does that actually look like? And you think about the people who are coming to your area and they're only planning to stay for a short period of time. You're talking about, single people, right? You're talking about, you're probably usually not talking about families who plan to stay for a long period of time. And I can just imagine that while the average tenant stays X number of months in those kind of multifamily properties, your number is going to be significantly reduced, right? And that's going to affect you, especially if you're not factoring in a proper vacancy rate, turnover rate. And the problem with all that vacancy and turnover is that's usually when the big expenses come, right? You're like, if you're changing carpet, if you're painting, that's usually when you're doing it. So, single family or multifamily, what you really want is a whole bunch of people who stay for 30 years and don't mind rent increases every year, right? That's what you really want. And, it's unrealistic. So,
Yeah, I think to your point, Kevin, every market's got a little bit different lease renewal rate or turnover rate. And, we've seen national average is like 52% of tenants basically turn over. And those numbers are all measured from large apartment syndication type units all across the United States, millions and millions of units. So definitely some markets have higher, some markets are lower. So I think it's it's something good to understand. But then when you look at it just on a really, really basic level and you say, hey, I've got a fourplex, and if the turnover rate is 50%, if that's your average, that means two of your tenants are going to leave every single solitary year. And the ability to renovate those units, get them released with somebody else in a very timely fashion is critical to your return on that investment. And, depending on the area that you buy the property in, something like that, or the criteria for placing somebody in the property, all of that can be factors on how fast that can be done. Um, and so anyway, it eats into your returns. And you oftentimes you don't see that on paper because nobody's talking about that. Really, what people talk about when they talk about the multifamily is they talk about, if you have a vacancy, you're only going to be out of a fourplex. If you have one vacant, you're only 75%. You're 75% occupied, 25% vacant. Um, but they don't talk about like the turnover. They don't talk about the cost. They don't talk about, you know, hey, you've only got two people in the property. You still have to make the mortgage payment. Luckily, those two people made the mortgage payment, but where does the capital expenditure cost for replacing the carpet, painting the unit, all of that come from?
Real estate's still a fantastic thing. It's still great returns. It's wonderful, but man, when people are looking at a deal and they're writing these numbers out and they're factoring in what kind of mortgage they can get for whatever property they're looking at, that everybody looks at the ideal numbers. You're like, okay, well, if everything goes right, this is how much I should make, and then reality sets in and just eats away at that. It's always going down, right? And you know, it's just a lot of stuff to factor in, right? And then what raises that? You're talking about all these inefficiencies eating away at your income. Well, you know, I you got to stay on top of this so you get that margin back up, and then it might even go up over time as rents increase, your mortgage is not, and the value of your property goes up through appreciation. Don't forget about the tax benefits. You're writing off the phantom depreciation or however you want to look at it. But it is one of those things where people do forget the benefit of competent personnel. Whether you're doing a property manager, whether you got your own contractor, whether you're in there swinging the hammer, it's one of those things where if you pay attention, this stuff is great, and if you're not paying attention, you're going to look up and be amazed at how much money you bled out. Right. So
Yeah, I think so. One of the other things we didn't really talk about, like major multifamily, or basically those 5 units and above. You mentioned that 400 unit complex. But one of the things that I've seen with um, bigger, so we're talking, um, not, there's almost like this no man's land of like the 5 to 30 units is like no man's land. And the reason I say that is because the amount of labor and work that's required to quote unquote manage that, to maintain it, repair it, um, those costs can annihilate you on those because basically there's not enough units to create enough margin to basically allow for you to hire a handyman and basically like pay somebody a salary, um, to basically be on site doing some of the minor repairs that would eat you alive if you didn't have that person as a staff member.
yeah, you're somewhere in between of let me just hire you know handyman and pay retail for repairs. You don't want to do that when you got 40 units, right? But you're not quite there where you can just hire a handyman and pay him full time. You're somewhere in the middle. And it's kind of the ideal situation of either buy two of these complexes so for a combined 100 units, or you need a property manager who does have those people, and you're paying for half the guy's time and half his time is being spent somewhere else. It's not on your bill, because you're right. It is no man's land, and it is. It's. I don't know. I see it as a ideal situation for somebody who's already got one down the street. Be it 100 units or 400 units, and this is like 2 blocks away. So yeah, I'll add an extra 40 units. But if you're going from 3 and 4 units to 40 units, this one's brutal to take on, right? So yeah.
Absolutely, and we've seen it. Just local investors here. I remember meeting with somebody, and they bought it. It equated to about 50 units, and basically touched base with him a year from there, and he basically said, it was horrible. Like things were not going well. He had tried to self manage. He had retired, essentially from the military, and he's looking for quote unquote a property manager. um, and then he realized that basically he had to get up to 100 units as fast as possible so he could actually hire that property manager for himself and hire that maintenance guy on his own payroll, so that all of the math and all of the spreadsheets that he had run to buy these properties, it would actually start to make sense. So it was really
Yeah.
neat to see that, because you can, again, the best spreadsheet, the best ideas, the best run numbers, um, it's all good until you actually hit the street and you start doing this stuff and you're in the trenches. Sometimes, a lot of times, it doesn't pan out the way your beautiful spreadsheet basically told you it will.
Yeah, and you'll find exceptions to this rule if you're your own handyman, right? If you're your own on the ground guy, right? So you'll find exceptions out there, but in general, you start looking at those numbers, and there's almost like plateaus, right? You know, at this plateau, the math works here, but if you get up here, it starts to really just suck until you hit the next plateau, and things start to the equations start to equal each other at that point. Yeah, and we've hit a couple of those, and it feels like there's always the next one.
Absolutely. So we really hope that you gain some valuable information from this podcast today, and we can't wait to do the next one and hope that you'll join us for the next one. Take care, guys.